take my hand and come with me because you look so fine that I really want to make you mine. I say you look so fine that I really want to make you mine. 4, 5, 6, come on and get your kicks. Now you don't need the money when you look like that, do you, honey? Big black boots, long brown hair. She's so sweet with her get back stare. Well, I can see you home with me, but you were with another man. Yeah, I know we ain't got much to say before I let you get away. Yeah. I said, are you gonna be my girl? It's 1, 2, 3, take my hand and come with me because you look so fine that I really want to make you mine. I said you look so fine that I really want to make you mine. 4, 5, 6, come on and get your kicks. Now you don't need the money with a face like that, do ya? Big black boots, long brown hair. She's so sweet with her get back stare. Well, I can see you home with me, but you were with another man. Yeah.
Good afternoon, everyone, and welcome to today's webinar hosted by the M&A Advisor. We are delighted you can join us. Please submit your questions throughout the presentation by using the question box on your screen. Our presenters will answer as many as possible during today's interactive virtual session. If you have any technical issues, you can contact us by using this chat box or simply hit help on the bottom of your screen. I'm Rachelle Kakouris, a director in the research team at LCD, which is a division of S&P Global Market Intelligence. And I'm looking forward to an interactive and engaging afternoon with you today. I specialize in data-driven trend analysis and commentary on the leveraged finance markets, focusing my efforts on showcasing developments and movements as tracked by LCD's S&P LSTA Leveraged Loan Index, a widely used proxy for the 1.2 trillion leveraged loan market. I'm going to start off by giving an overview on the lay of the land in terms of distress and pain points in the markets by the numbers using S&P data before we turn over to our panel to dive deeper into the opportunities and strategies around distressed debt. So turning to our first slide. So I think it will come as little surprise to anybody that we've seen a massive uptick in the volume of defaults by 244% to be exact to the same period of last year. Of course, the economic fallout of the COVID-19 pandemic continues to impact corporate earnings and the capacity to service debt. But what I think might be surprising to some is that less than 20% of this has actually come from true pandemic-related situations or situations stemming from the April oil price plunge, at least when it comes to the leveraged loan asset class. How am I defining that? Well, companies marked single B or higher before the pandemic hit. There are some grey areas to this that exist among companies that were already rated CCC beforehand, but the only one that would significantly move the needle being is heavily indebted Intelsat, which they made mention of COVID in their court documents, but its reasons for filing ultimately extended beyond the pandemic, namely needing to right-size their balance sheet for C-band spectrum. So that's less than 9 billion of the 48 billion trailing 12-month volumes for August that are what I would term pandemic situations in the truest sense. So where does this leave us? Well, turning to my second slide, with default rates already at 10-year highs. By issue account, the default rate of the S&P LSTA Leveraged Loan Index climbed to 4.31% in August, the highest reading since September 2010. The US speculative grade default rate at 6.2% is the highest since June 2010, and this is a preliminary figure. By amount, the loan default rate at 4.08% is at a high mark since February 2015. If we exclude Energy Future Holdings and its outsized 20 billion default in 2014, the rate by amount would also be past 10-year highs. So moving to our next slide, in a quick look at where defaults are coming from within leveraged loans, oil and gas is significantly outtrending once again, with 29% of all defaulted loans coming from this sector. Many in the industry, of course, have already tried to right-size their capital structure in the past in an effort to ride out what would be a historic and sustained low price environment, only to come back for a second or third time, some regardless of the April plunge in prices. California Resources, which filed for Chapter 11 in July, had previously attempted a far-reaching exchange in 2015. Fieldwood Energy defaulted in May upon failing to make payments on its term loan just 1 year after emerging from bankruptcy. Ultra Petroleum also filed for bankruptcy after completing a distressed exchange in 2018, roughly 1 year after emerging from bankruptcy in 2017. So third time's the charm there. In COVID-specific defaults, we've seen well-known brands from brick and mortar clothing retailer Men's Warehouse, restaurant group Chuck E. Cheese, Hertz, Cirque du Soleil, and 24 Hour Fitness, which join a nascent, at least within leveraged loans, but growing list of companies that have endured a quick decline from the single and double B ratings bracket to bankruptcy or payment default. Looking ahead to our next slide, distress ratios and downgrades have historically proven an important forward indicator of future default activity. The volume of loans priced below 80, which is an informal barometer of distress in the loan asset class, jumped to 672 billion at the height of the March sell-off, which in part thanks to the growth of leveraged loans in general, outpaced the 2008 high by 40%. The distress ratio has since staged a dramatic rebound from the March 23rd 57% peak and March month-end reading of 24%, this chart showing the month-end readings, though it remains elevated by historical standards at 6%. Note, of course, while the distress ratio peaked at 81% during the Great Financial Crisis, the loan market has since doubled in size. An 81% distress ratio in today's world would equate to almost 1 trillion of distressed loans. We will talk a little more later on what this growth in the market means in terms of default volumes. But ultimately, is the loan market being overly optimistic? As we detail later, given the ratings deterioration of the loan market, the credit deterioration at the company-specific level by several measures, and just a general uncertainty, it would certainly appear so. But I'd obviously remind this is a lagging indicator, so defaults are still to come. Loans, of course, are priced off higher recovery values. So as we look to our next slide, high yield bonds can offer a better indicator of how the markets are viewing the fundamental picture. Here, as we see in high yield, distress volumes, we have a little over 113 billion priced in distress, or 1,000 over treasuries. At the peak in April of this year, this reached 440 billion. Again, with the high yield market more than doubling in size since the Great Financial Crisis, the April distress ratio peak of 30.6% is far below the 2008 peak of 77%, but that equated to just 365 billion of distressed paper. So there's a lot more potentially to chew on this time around, even with lower distress ratios. Turning to our next slide, where stress matters. Here, looking at sectors with a meaningful market share above 1%, and we're talking leveraged loans again. Across the sectors, air transport now leads for sector level distress at 35.6%, which is this the top blue line marking the most current levels. This sector had no loans in distress at the end of 2019, which would be the grey line you see on other sectors. Oil and gas, previously taking the lead per the red line, which marks the April figure, now comes in second at 25.4%. Distress remains elevated in oil and gas in spite of the spate of recent defaults that were flushed out of the calculation. Leisure and retail, taking third and fourth, have seen distress levels come down from the end of April, though this is more on account of default activity than lower distress in the industry. Leisure in particular saw a big jump from a minimal sector level distress at the end of last year. So to our next slide, in another forward measure, downgrades have outnumbered upgrades at a heady rate since the pandemic took hold. You can see in this chart heightened downgrade activity in similar vein to spiking distress typically precede a period of rising defaults. To that end, through August, nearly 40% of the loan market by par amount at the facility level had received a ratings downgrade this year. So it's 40%, which represents nearly 450 billion of the 1.2 trillion of index loans. That's a lot of loans downgraded. In the 3-month rolling calculation across March, April, and May, downgrades outpaced upgrades at a staggering 43-1. So 43 downgrades to every 1 upgrade. The ratio has since tapered off, but nevertheless, the post-COVID-19 downgrade cycle further weakened the quality mix of the leveraged loan market, with the share of index loans rated B- or lower at the corporate level swelling to nearly 33% by August. So a third of the loan market rated B- or below. And this compares to just 10.8% 5 years ago. Triple C or lower represented 10.3% of the index in August, compared to 2.97% 5 years ago. So we have seen a significant deterioration in the quality of the leveraged loan asset class. So turning to our next slide, looking again across the sectors. Leisure, despite making up only a little over 4% of the loan index, newly tops the table for the most downgraded sector, the blue line showing the year-to-date number at 11.8% of all loan downgrades. Business, equipment, services, and electronics, by comparison, are some of the largest sectors in the loan index, making up 9% and 14% respectively. And so their position on the chart is not entirely unexpected. Autos and hotels and casinos did not feature in the top 15 of downgraded sectors before the COVID crisis. They now have a downgrade share of 4.36% and 4.2% respectively. So turning to our next slide, while price-based measures of forward metrics for future defaults may have come down significantly, second quarter earnings brought the first full pandemic picture of the damage caused by global lockdowns and months-long closures of non-essential businesses, and it's not pretty reading. Looking back at what was one of the weakest earnings quarters for corporate America, public filers within the S&P LSTA Leveraged Loan Index, on average, reported a 23% year-over-year decline in EBITDA, exceeding the prior peak decline of 18% recorded in the first quarter of 2009. The blow to earnings leaves the credit markets in uncharted territory. Leverage soared to a record 6.4% on an average basis in the second quarter across the sample of loan issuers, up half a turn from the first quarter and adding considerable distance from the healthiest reading of the now derailed decade-long economic expansion, or the 4.76 leverage reading in the final quarter of 2018. The resulting rise in leverage has a historic percentage of the index sample skating on precariously thin ice. As this chart shows, a staggering 35% of public filers, which LCD tracks in the loan index, carried a leverage of greater than 7 times into the third quarter, nearly double the proportion a year earlier and up from 14% at the cycle low for leverage in the fourth quarter of 2018. For reference, that outer edge proportion of highly levered credits was just 20% in the final quarter of 2008 and 16% a year later. So companies are certainly carrying much greater leverage this time around. While there's no way to sugarcoat these numbers, leverage companies are in a better position to service this debt than they were at the outset of the great financial crisis. With most defaults occurring before maturity, coverage ratios are an important indicator of a company's ability to maintain its debt. And with that said, 29% of issuers were operating with a cash flow coverage of less than 1.5 times, a level typically indicative of higher default risk. In the final quarter of 2008, this was as high as 44%. Average interest coverage, though dipping to a 7-year low of 4.1 times, is a full turn better than where it stood in the third quarter of 2007 at the onset of the credit crunch. So in terms of managing this debt load, the companies are looking better this time around. And turning to the next slide, also potentially helping the near-term default landscape, companies are negotiating amendments and covenant relief to stave off a potential default wave, potentially less painful than initially feared. Or certainly we could see as a result a default picture of lower for longer. Riding the coattails of the Fed's sweeping measures to prop up the capital markets, a record number of US companies saw breathing room on loan terms as falling earnings left them at risk of breaching covenants. Pro rata loans, which have not suffered the same deterioration in covenant maintenance packages as term loans, account for 93% of the 133 billion covenant relief volume so far this year, compared to 42% during the great financial crisis. What is this telling us? Well, it's telling us that despite the proliferation of covenant light within the term loan market, when it comes to maintenance covenants, companies are still being brought to the negotiating table via their revolver agreements, though term loan lenders might not necessarily benefit from the increased economic terms. Looking at volumes, while covenant relief activity is less compared to the last crisis, we've seen a record 162 transactions through the first 8 months of 2020, which compares to 154 in all of 2008. Of that 162 number, 152 occurred after the start of April. So turning to our penultimate slide, again, thank you, Fed. Many issuers over the last decade, and indeed in the shadow of the pandemic, have been able to considerably bolster their defenses against a downturn by tapping the debt markets in record numbers to extend maturity profiles and refinance at historically attractive funding costs. Even some of the most hardest hit borrowers from the pandemic, including airlines, hotels, and cruise operators, were able to tap investors for financing, sometimes paying double-digit coupons to do so, though the conversation has moved on increasingly from liquidity preservation to terming out debt maturity profiles at progressively cheaper costs of funding. So the formidable maturity wall now does not start until 2024, giving us some runway for companies to actually meet their full debt repayments, though loan issuers bear a significant brunt of this over high yield. And then finally, to the final slide, I just wanted to round this off by highlighting LCD's annual recovery study. Of course, with defaults on the rise, recoveries are increasingly in focus, and there's a widely held expectation that for various reasons, loan recoveries in particular could be worse this time around, and we're certainly trending downwards. Using S&P's loss stats data, our analysis has found that newly added instruments across bonds and loans I should say newly added defaulted instruments across bonds and loans last year, had an average discounted recovery rate of 66.3%. This has declined each year from 81% in 2016, notably as distressed exchanges decreased and bankruptcies increased. The average discounted recovery rate for bank loans at 74% is down from a historical average of 80%. So in conclusion, I think the fear of mass defaults is fading, but the numbers do not necessarily stack up. Street estimates for peak default rates have come down since the initial March panic, but they remain pretty high. So LCD, we conduct a quarterly survey of loan portfolio managers on their expectations of the default landscape and returns. And the results are still coming in, but an early read suggests that buy-siders are still expecting loan defaults will peak near 7% on a trailing 12-month basis in this default cycle. Predictions back in our Q1 read, when the Fed support was still being rolled out, range between 7 and 9%. So not really a huge revision there. To put this into perspective also, when default rates hit a peak of 10.8% in 2009, the LTM defaulted amount was 63 billion. In today's market, it would require a default rate of only 5.4% to reach the same amount of defaulted loans. In high yield bonds, S&P Global Ratings Research still expects a US trailing 12-month speculative grade default rate of 12.5% by June 2021. So the silver lining here really is the unprecedented pace at which funding markets have normalized, which has helped to substitute cash flows with debt. The key, as always, remains market access in this transition phase of the early cycle, given that this will determine the staying power to get to the other side of a recession. As we saw, cash buffers remain healthy for now, but increased borrowing costs cannot increased borrowing cannot substitute earnings indefinitely. And with that, let us continue with our panel discussion. I would like to turn this over to Alexander Gladstone, reporter with the Wall Street Journal.
Thank you, Rachelle. And now let us continue with our panel discussion. And Rachelle, we look forward to you joining us for the Q&A segment later. And a friendly reminder to our attendees, if you haven't submitted a question yet and wish to do so, please enter it in the question box on your screen throughout the session. I'm Alexander Gladstone. I'm a reporter at the Wall Street Journal and WJ Pro Bankruptcy. And I cover distressed companies, credit defaults, debt restructuring, and pretty much any time that a company is in trouble, either legally or financially. And so I'd like to introduce our panelists. We have the Honorable Kevin Carey, who is a partner at Hogan Lovells, their U.S. business restructuring and insolvency practice. He is a resident in the firm's Philadelphia office. Judge Carey was first appointed to the Bankruptcy Court for the Eastern District of Pennsylvania in 2001, and in 2005 began service on the Bankruptcy Court for the District of Delaware, and as Chief Judge from 2008 to 2011. Judge Carey is on the Executive Committee of the Board of the American Bankruptcy Institute and serves as Vice President of Membership. Judge Carey is joined by Perry Mandarino, Senior Managing Director and Co-Head of Investment Banking and Head of Corporate Restructuring at B. Riley Securities. Perry Mandarino has advised several hundred companies over a 30-year career in corporate finance and has significant retail and consumer expertise. Anyhow, let's dive into our session. So one thing I'd like to touch on is that while bankruptcy rates have been spiking amid the pandemic, and there's been sort of a massive influx of fallen angels amid the wave of credit downgrades, both the total number of bankruptcy filings this year and downgrades have actually been less than people anticipated when the pandemic began at its full capacity, I guess, in March. And so part of that, I think, is that the Fed initiated its bond buying program under the CARES Act, and central banks around the world have been uh, taking measures to prop up struggling companies. And so I guess when you're looking at distressed investing opportunities, to what role do we think these kinds of monetary measures will continue, and to what extent might they be unsustainable down the road? So maybe Perry can weigh in on that.
Sure, and good afternoon, everyone. It's interesting because you've seen so many different industries that haven't previously been troubled, all of a sudden have troubled: the cruise lines, hotels, and it's been a long time since hotels had a widespread problem. Certainly, the PPP loan program, to a great extent, to a lesser extent, the Main Street loan program have certainly helped companies put off any formal type of filing. And what else is interesting is that this is not a problem of bad management by companies. This is not an issue of a widespread sector decline. It's truly a once in 100 years or more, I hope, pandemic that has come along. And it's not about cutting costs. It's about having people come in your store or your restaurant, or being able to keep your manufacturing facility open, or have people fly on an airplane. It is so different that there's the expectation of a recovery, of a swift recovery, maybe not V-shaped, but nonetheless, there's an expectation of a recovery. And I think that expectation is driving a lot of the maybe the less activity in court than we would have imagined.
Do you think that markets are baking in the possibility, and in fact, seemingly likelihood of a second wave of coronavirus this fall and winter? Do you think that the market has baked it in or not?
It's maybe in certain sectors it has. I mean, but you look at what just has gone on in the Dow and the S&P and even the Russell. That, I mean, you would think that that like everything's going to be okay, and the markets usually view as what's going to happen in the future. I think Americans are people of incredible hope and faith, and I think that there's views that with the good news that certain pharmas now are doing large scale testing, and the spread has become maybe less in numbers. Maybe in certain states it's higher than it was, but the numbers are not like they were in March and April. And again, the government assistance is really propping it up. In my view, the election could have, over the next month, could have as much of an impact as a second wave.
Because of how that might impact central banking, or what? Or
how it may impact consumer and business confidence, taxes, the macro thoughts of what may happen, post, if there's a new administration, or if the current administration continues. Will there be more riots in cities? Will New York be able to open back up again? All those factors, I think, is why the election is meaningful.
Well, so much is unknown about what will be. I was speaking to a financial analyst recently, and I said to him, apart from what the epidemiologists are predicting with respect to the pandemic, with respect to the businesses that you're following, what are they planning for next year, for when the effects of the pandemic will ameliorate a little bit and allow businesses to get back to the regular order of things? He said many are planning a recovery from the, well, not a recovery, but the beginning of a time to get back to normalcy in the second quarter of next year. What I didn't ask was, does that account for, a resurgence during the colder weather?
Yeah.
But I guess if we're looking at the second quarter of 2021, it might very well account for that resurgence. But in the end, nobody really knows. And it's the uncertainty, I think, that's the central dynamic right now of what business planning is about.
Yeah, and I think part of it is not just that there could be, or I guess is likely to be a resurgence when people are, inside more in the wintertime. I think on a deeper level, it's that people's behaviors might fundamentally change and people might get ingrained into certain habits even after they get vaccinated one day. People might just have different ways of spending money or different ways of living in the world. And for example, a company that I cover very closely is AMC Entertainment, which is the world's largest movie theater chain. And 8 months ago, AMC was a very healthy company. It was the world's biggest and best movie theater company. Now it's very, very distressed, and it has bonds trading at very, very low levels. It really faces the prospect of a credit default. And the question is, even when people can come back to the cinema, I mean, now they are opening up their theaters, but there's still government, I guess, restrictions of how many people are allowed to come back in. And even if it weren't for those restrictions, how many people would want to sit in a closed room with no windows for 2 hours with a bunch of strangers? And even beyond that, when there's a vaccine, it could people just have gotten more into streaming, and people no longer really want to go to watch movies in person anymore. So just what I'm thinking about is it's not just whether we can go back to restaurants and bars or whatever in 6 months. It's will people's fundamental behaviors change, which could have serious ramifications for a lot of businesses, especially in consumer-facing businesses. So I wonder what you guys think about that.
Yeah, sports entertainment.
Yeah.
Right? I mean, it's wild. You watch football games on Sunday, and there's no one in the stands. Now, being a New York Jets fan, maybe that's a good thing. But nonetheless, concerts. I mean, concerts it's a multi-billion-dollar industry. Entertainment, cruise lines, as we talked about before, vacations, flying to Europe. It is so fundamentally different than anything any of us have ever experienced. I think, as Judge Carey said, we're just trying to figure out, and no one knows, and we're trying to do things that are smart and safe.
Yeah, the distancing is so antithetical to our cultural way of doing things. We are a society that likes to be among each other,
Yeah.
and that has been severely curtailed.
Yeah. But it seems like what's happened, I mean, to me, what's happened, the fact the stock market has recovered so much, part of it says to me that investors are banking certain kinds of high quality companies are going to be around no matter what. And so there's been sort of like a flight towards quality where, people are putting their money into the S&P 500, like big, well-established companies that are going to be around after this pandemic. But so I'm wondering, is that creating a dynamic where stronger, healthier, better companies get financing, and companies are sort of middle of the road are getting left behind, and that could create further destruction? What do you guys think about that?
Well, that's kind of the classic formulation of what happens in a downturn, in any event, no matter the cause of the downturn.
Yeah.
And as Perry indicated earlier, there are businesses that were managed well and doing fine, but for the pandemic. And to the extent that these companies can survive for the duration of the pandemic, or until, a vaccine is widely available for distribution, the strong companies will be strong, and the ones that haven't been strong or had problems before the pandemic will have difficulty.
Yeah, I mean, look at, for example, what Delta Airlines is doing. They publicly announced that they're borrowing, I think, $6.5 billion off their frequent flyer program, and they think that will get them through the end of 2021. Now, presumably they're thinking that's worst case, and so they're funding towards worst case. But and I was on 2 flights since March started, and what was very odd is that Nashville Airport was busier than Newark Airport in terms of just number of people. And it's a matter, as Judge Carey was saying, it's just having enough resiliency and liquidity. So behavior's changing with the institutions that hold the debt. because there are a lot of cash flow businesses, if the lenders were to just decide to foreclose, then it's what cash they have and perhaps what maybe some receivables they have. There's not good answers. So the best answer there is right now is patience and waiting for the tide to turn permanently.
Yeah. Well, that brings me to my next question, which is, we've seen, this is about the timing of the distress cycle and looking out into the future. After the pandemic hit, there was sort of a wave of companies, the ones that were able to do so, tried to raise as much debt as they could to sort of tide them over. And so AMC did that, as I mentioned. And a lot of companies were able to sort of get investors to buy in, bank or bet on our recovery, put money into us now, and then 3 years from now, you'll get paid out and it'll be a good investment. So this resulted in sort of a debt binge. I don't know the exact number, but I believe there was a massive issuance of new debt, especially senior debt, over the past 6 months. And so this means that there's going to be debt maturing years down the road, which there's probably going to be a maturity wall that's going to hit a few years from now. So that it might postpone this distress cycle, but it doesn't resolve it. So what do you think about that?
I think it's a good point, Alexander, because the amount of new issuance of, say, CLOs, right, every week it gets higher, right, billions of dollars, and it just gets higher. So there's liquidity in the market, which is a good thing. And I think we're in just a cycle of there will be extensions, or perhaps in 3 years from now, say, or 5 years from now, if there isn't a permanent recovery, then that's when the world will really change. So maybe that's why the market is being optimistic, because they know for the short term, call it a year, there seems to be enough support. And what happens down the road, what happens with, again, the macroeconomic issues of taxes and trade, and what happens with trade and what's going on around the world. I mean, it is not, we are in such a global economy that, and the other unusual part about this pandemic is that it's affected the world, right? It's not just limited to the United States and Europe or the money centers. I mean, it's affected everywhere. It is patience, something that a lot of people in finance aren't very good at.
Now, and this is directed to both of you. Do you find that many of your clients on the investment side, on the buy side, I presume that many of them have been lenient and have granted amendments and waivers and stuff like this to sort of, hey, I understand there's the pandemic. Of course, the reality is different now. I'll give you guys I'll let you guys waive those maintenance covenants for the next 12 months or whatever. I presume that both of you have clients who have been lenient about this, given the circumstances. But do you think that they may ever come to regret that?
Well, okay, so let me say something about the maturity walls. In our business, from time to time, we see the walls and we say, what the heck is going to happen when we reach that time? And it never ends in disaster unless there's something else, okay? And in this case, maybe if the pandemic effects hang on, that's the something else. We've had times when, there's been a 9/11, that's the something else. When we had the 2008 financial system collapse, that's the something else. So, the maturity walls tend to seem to move unless there's one of these other forces that comes to play. But yeah, in terms of what will happen, in a year, or will people feel differently about how they should be investing or lending? And the answer is, it depends. It just depends. And again, you come back to the thing that Perry said, that the many businesses were fine and will be fine, whether it's in 2021 or 2022, when they finally get rid of the effects of the pandemic. But the other part of it is, again, what Perry said, is that we are an incredibly optimistic people. We have this view, rightly or wrongly, that there's nothing we can't do when we put our shoulder to the wheel. And so that keeps things going. I mean, in part, that's, I think, a reason for sometimes stock market volatility. It's an emotional thing because, a company doesn't change overnight necessarily, but all of a sudden enterprise value did for a reason that you couldn't really understand.
True, but how does that play into different sectors, though? Because there are certain sectors that are pretty clear are going to make it through this crisis. Other sectors may not. So it's not an evenly distributed.
No.
I agree with you. We are an optimistic people, and investors do have a long-term view that we are going to bounce back one day. But not every sector is going to survive, and you're seeing the coal sector they were already in trouble well before, but now it's really truly a dying industry. And I guess I think I spoke with Perry earlier, and what we're seeing is that, while distress has been concentrated amongst energy and retail for the past few years, now we're seeing that this pandemic has created a whole new set of sectors which are distressed. And for example, Hertz Rent-A-Car, it wasn't the healthiest company in the world, but no one thought they were going to file for bankruptcy until the pandemic hit. So we're seeing sort of new sectors we didn't really anticipate before getting distressed. And I just wonder what you guys think about how investors are looking at these different segments and how they can maybe find opportunities in them.
Well, and Hertz was so optimistic they even thought about having an equity raise until the SEC told them no.
In bankruptcy. That was one of the unusual things that I've seen over time. I think I think that there will be a rebound in those industries that are being affected by top line, travel, vacations, entertainment. And it's a matter, maybe entertainment's in different steps, like AMC may be different than filling up MetLife Stadium with 80,000 people for a Springsteen concert. And will be different than going back to vacation to Europe or the islands, the Caribbean. So I think there will be a slow step. I think when a vaccine comes along, I think it will be incumbent on people to take the vaccine. And there have been some polls out there where like 30% of the people are saying we're not going to take it because I don't know what's in there. It hasn't been tested the way a normal drug would be tested. I mean, there's so many curveballs. And to your point before, Alexander, like habits, right? Human beings are great adapters, right? At the beginning of the pandemic, I hated having to work from home, right? And it was just, your lifestyle changes, but then you sort of, you get used to it and you become efficient and you're getting deals done. And going back to it, I think it's necessary. I can't wait to go back to the office and see my colleagues, as Judge said. It is, we're meant to be around people. We're meant to interact, and it will. What's incredible about all this is that how well business is still doing, right? Other than those that are just affected by people that there's no people in hotels and renting cars, but business is staying solid. It's strong. We've gotten 2 M&A deals done during the pandemic, about to get 2 more done in the next few weeks. It's incredible. And these are real businesses with real dollars and real employees, and jobs are being saved and there's growth.
They've found a way to manage through this pandemic.
Right.
Yeah, I guess another thing which I've been thinking about is just, in many ways, the pandemic created massive opportunities for certain kinds of startups. Like Zoom obviously is, I guess, probably the most well-known and famous. I call it a success story of the pandemic. But what other kinds of innovations are you seeing, or companies are finding ways to offer new products or services that meet the demands of the moment? I mean, that's another way of looking at distressed opportunities, finding those who can either rise from the ashes or find new ways of doing things given the current paradigm. So I'm just curious, if you guys have been looking at that.
I think one of the new ways of doing business is going to be maybe a movement away from the just-in-time inventory system, which we've been operating on for a long time now. Because what happened when the pandemic struck is that were shortfalls that manufacturers were not designed to deal with because there was no inventory. I think you're going to start seeing some of this real estate that may end up having to reconfigure because of the loss of tenants, end up offering some warehousing space. There was an article, I think it was in the journal, about paper towels. They're not stored because they take up too much darn room. But people need them and want them, as we found out.
Yeah.
It's just one example of how things may change in that respect.
It takes 2 months to get a fridge now from General Electric. And I'm speaking from experience, by the way. It's got a new fridge. That's because the factory's stopped. That they're just everything's back ordered. So your point is that this might change how companies view their supply chains, and how might they make improvements? What do you think that could the outcome be in terms of the change that they make?
It's carrying less inventory. I mean, I've seen it among retailers right now, inventory management and working capital management. And it's been phenomenal because in a couple examples of clients that I have, they have less inventory, but their margins have gone up, right? Because they're effectively managing what they're selling. I think supply is
mean, right?
I'm sorry?
It's a leaner, meaner operation.
That's right. And I think it's going to provide innovation and efficiency. I think transportation may change, right? I think you may see, airlines going to smaller planes and, just different patterns. I think energy may change because just the lack, it could really be a catalyst to more efficient energy because you just don't need all that oil anymore.
Yeah,
almost in every aspect, and then you have construction. It has been said America's infrastructure is pretty bad, and just the type of road work that I've seen because there's less people traveling. And the government, when the federal government makes changes and they want to pump up the economy, they generally start right with infrastructure. And I think you could see America's infrastructure getting a lot better.
Well, let's see what happens after the election. I think promising infrastructure week the whole 4 years. So
yeah, there's that E word again.
Yeah. Interesting. But and in terms of like distressed investing opportunities, the key time to invest or to make a distressed opportunity is when something gets oversold, when a company seems like it's having a major problem, and the bonds and the stock and loans all drop, and then it actually gets oversold a bit, and then people can buy that dip and recognize the value inherent in the company. But do you think that moment may have passed? I've heard that there's been some major distressed hedge fund managers who said that the key time to buy stuff was back in like March and April, when the market was in a frenzy. Could it be that the moment to buy cheap but valuable companies has passed, or we need to look at it differently now that we're on a bit further down this pandemic cycle?
Well, it's passed for now, Alexander. Back at the end of March, I think, the CS loan index, I think it reached its low and it was like 76, 77. That was the average price of paper. And so you had double B credits that were trading in the high 70s, low 80s. The yield on that was enormous. Now I think it's back up to, it's in the 90s, it's in the low 90s. So yeah, do I think back in March was the time to buy some of the paper, and there were some great returns by those hedge fund managers? Absolutely. It's a cycle, and maybe that's the point, is that there's always cycles, right? We've seen it. We're, Judge Carey and I are old enough to have been through many of them. Yeah. But the cycles now may be shorter, right? We went from March to August, where it was low to high in terms of the prices, or September, the prices of bonds, or the prices of leveraged debt. And maybe that cycle is going to happen not another year, but it's going to happen in another 6 months again. So it's opportunistic. It's looking at fundamentally good companies.
Yeah.
I think that's a good point, that the cycles that we've seen historically won't be the same cycles anymore. I agree. There'll be a different time frames between them.
Now we've touched a bit on, I guess, industrial innovations or operational innovations amid the pandemic. But what do you guys think about have financial innovations also occurred during the pandemic? I haven't done the research on this, and I'm sure other people have. The growth of private lending, SPACs is now a big thing, special purpose acquisition companies. Would you say that the pandemic has driven any new trends or developments in financial innovations and new practices in this field?
Yeah, sure. I think the commercial regulated lenders are being very careful as to the loans that they're underwriting. They're under pressure from the OCC. I think, yes, specialty lending, there's been, again, tens of billions of dollars raised by specialty lending companies, SPACs, which, my firm has been involved with for the past 3 years. I mean, we did 2 SPACs on our own for our own balance sheet. I mean, they are an incredibly good tool that investors like because there's some real hedging on how on making the ultimate investment decision. Absolutely, there's new things that evolve, and when we look back in 3 years from now as to this time, what's happening. It's like technology, right? What happens in such a short time frame is extraordinary compared to what used to happen in business cycles.
Judge Carey?
I agree.
Well, listen, it was been a pleasure talking with both of you gentlemen, and we will now transition to the question and answer period. So I hope that the audience or members of the audience have submitted questions, and we can take a look at those and weigh in on them.
Good afternoon, everyone, and welcome.
All right. So now moving on to questions. This one is directed towards Rachelle. And the question is, what do you think accounts for your expectations of lower recoveries and distressed debt?
Yeah, so it's a good question. I mean, I think it's, the same aspects that have mattered in the past will continue to do so. So subordination, debt cushion, the time of the cycle and sector within collateral to recover, leverage, time to default. But this time around, I think we have some significant differences. So CLOs now make up a significant amount of deal allocations compared to during the last crisis. And covenant light as well. A significant amount of the loan market is made up of covenant light loans compared to in 2008, I think it was somewhere around 15% compared to around 80 this time. So, I mean, we've seen that lenders are able to be brought to the restructuring table, but how much leveraged loan lenders will benefit from this remains to be seen. So, there's a lot of moving parts when it comes to recoveries, but the expectation is this time we could expect recoveries to be somewhere around 10 points back of the historical average. So we're looking at probably 65 to 75 on average. But yeah, the typical aspects continue to play out probably.
How far out have you modeled that? Like you're saying 65% recoveries, what, for companies that restructure now or over what time frame?
Over the downturn, so for this next default cycle on average. I mean, it's not a hard and fast number. I'd have to look to see on the rating side if we've modeled that, but that's generally kind of a feedback that we hear from the markets. At least
how does that compare to the 2008, 2009 crisis?
I'd have to look at the data, so I'll come back to you on that, but we'd still imagine it to come in lower, so I'll come back to you on that one.
Good. Okay, now we have a question for Judge Carey regarding cross-border insolvencies. And the question is, given this is obviously a global pandemic, have you seen an uptick in cross-border insolvencies or do you expect those to, what do you anticipate for the future in this regard?
Well, as we all know, business has gone global. And as a result, many companies have operations or assets or property in a number of different jurisdictions. We've been counseling a number of foreign clients on the multiple choice of where do you file your main proceeding and where do you file one or more ancillary proceedings, and are the jurisdictions we're talking about, do they subscribe to the model law, the US Chapter 15, or don't they? So I will tell you the exercise of having to figure out the proper venue is really a challenging one, and because our firm is global, we do face this routinely. Now, there haven't been that many filings yet. I think the clients are basically, give us a plan if we need it, and that's one of the things we have been doing.
I think Aeromexico, that was a pretty well-known this cross-border case. What other major cross-border or Chapter 15s have happened since the pandemic?
Chapter 15, none come to mind especially, but LATAM filed. Foreign airlines seem to like the U.S. Chapter 11.
Yeah,
that's not an unusual thing, and I think even other companies which are foreign-based might very well prefer a Chapter 11 because of all of the tools in the toolkit it offers a company. The interesting thing is, because of the recently enacted European directive, EU countries have been in the process of changing their insolvency laws to provide more Chapter 11-like features. So when they're fully in place, that could also impact the exercise of where a company is best to file.
And Virgin Atlantic was a large Chapter 15 that filed in August. To your point, Judge.
Yeah.
I have a question coming in for Perry, which regards consumer spending, in regards to government aid. I know that I guess Congress is now stalled in a second round of stimulus, but what do you anticipate in terms of consumer spending as the money from the CARES Act runs out, and could there be another round of stimulus? And if not, what would the ramifications be?
Sure. Well, it's interesting. The jobs report last week that came out, the number of new jobs that were that hit were less than expected, but unemployment was also down, was lower than expected. So unemployment, which was, I think it's a little over 8% right now. If unemployment holds at that level at the same time that stimulus runs out, I think you will see a negative impact on consumer spending. I think consumer spending has been strong, as you could see by a lot of the comp store sales reports that companies have announced. But without stimulus and without the reopening of the doors, or the closing of more doors, it will be difficult to maintain that consumer spending, which could have a ripple effect post-Christmas or post-holiday season.
So you anticipate maybe another round of retail bankruptcies, of the ones that are still standing, or what?
It's retail has, my whole career has been, going back 30 years plus. Retail I've always worked on retailers. Retail has always been a sector that's been troubled, that there are bankruptcies. But sure, depending on what happens over the holiday season, and further store closures or forced government mandated store closures, then yes, I could see another wave of retail bankruptcies absolutely happening post-January.
And Judge Carey, over your many years of either working in the courts or I guess on both sides of the bench, what does your gut tell you how busy the courts are going to be over the next couple?
I think, the courts are busy now, although the number of Chapter 11 filings rises and falls month to month. I think the trend is upward, and I think it's going to continue to be upward. On the consumer side, there have been very few filings, actually, because of the government help. Although I think courts are anticipating that when that runs out, there will be a real surge in consumer filings. The one thing I'm looking at interest for is back in the Chapter 11 to see what effect that the new subchapter 5 part of Chapter 11 will have that was passed earlier this year, and to cover small, medium-sized enterprises. The CARES Act expanded the debt eligibility up to, I think, $7.5 million, which really would make eligible, and it's a voluntary election, they would make eligible the large majority of Chapter 11s that are filed. That may encourage more businesses to try 11 rather than to either
Chapter
just
7.
Yep, exactly.
Have you seen, so you said this was passed as part of the CARES Act, you said, right? Or
Well, the
statute
was passed before, became effective in February of this year. And then when the pandemic hit, Congress expanded the debt limitations as part of the CARES Act, which was a good thing. It was temporary. It only is effective for a year. But I think there are hopes that it will be extended after that.
Have you reviewed any data that shows that there's already been an impact, that more small businesses have been opting to file an 11 instead of a 7, or it's too early to extrapolate any data from that?
It's too early. I mean, the major fight that came right away was, the CARES Act said that if you're a debtor in bankruptcy, you don't qualify for the extra aid you'd get. So that was really one fight that was had early on with the small businesses. But I haven't reviewed the filing numbers on the subchapter 5 filings, but hopefully that data will be meaningful soon.
Well, maybe we can reconnect about that at the end of the year and see if there's anything we can draw from it, and maybe I'll even have an article. We'll see. Any other questions coming in from the audience? Let's see. What else do we got? Let's see. Do we expect that retail restructurings, the trend of retail restructurings, converting businesses from brick and mortar into online or online only, is that a trend that we expect to continue? I mean, I guess Perry can weigh in on that.
Yes. In fact, we just closed the deal that was announced on Thursday. It was the Retail Wins Inc. Bankruptcy, the New York and Companies, the brand and fashion to fitness. The court approved the sale in early September, and we closed on October 1st, whereby, unfortunately, about 350 stores were closed. However, the e-commerce business was sold. Really good enterprise value, good people behind it, keeping 100+ people employed, and it's a great brand. And you see the brand companies, the Blue Star Alliances, the ABGs, Marquee of the world out there aggressively buying brands out of bankruptcy, from BCBG to Barney's to Brookstone. Yes, I expect that to continue as the delivery system improves even more.
One of the interesting developments is the purchase of retail brands and stores by mall owners. I'm curious to see how they will do in this attempt not to lose tenants.
Yeah, I've been covering those. There's Simon Property Group, which has bought a lot. I guess they bought Forever 21, Lucky Brand Jeans, and now they have a pending deal to buy JCPenney. And they've teamed up with this Authentic Brands, which is sort of a branding company, on a number of the deals. I forget which ones. But it's a huge bet on. It's basically Simon is America's largest mall operator, and they're buying up a lot of their own tenants. So it's just a massive bet, I guess, on the future of the American shopping mall, and we'll see how that bet worked out, I guess, in a few years from now. But it
started with Aeropostale. That was their first.
That's right.
That was the first one. I think the company's known as Spark. That ABG has formed with Simon, and it's a great theory. I mean, like Burr said to Hamilton, you're adored by what you create, and it's an incredibly creative and well thought out of idea, where they can use the scale and expertise of omni-channel, as you hear that term, in order to ensure long-term success.
So you think that this is going to be a bet that's going to pay off, or do you think people will just stop going to shopping malls at some point?
Yeah, well, Alexander, I don't think it's going to be limited to Simon doing that. I mean, I'm aware of other landlords, different types of landlords that are buying up brands or buying up other retail concepts, or trying to buy the retail concepts in order to fill some dead space that they may have or anticipate having over the years. I don't know if the mall could be dead. I actually was in a mall yesterday, and it was the first time I was in a mall since March, and really? it was weird. It was a lot. It's usually a vibrant mall, and it was a lot less. It was empty. Not all the stores were open. Cartier had a line to get in, not a line. You had to make an appointment to get in. So I noticed that. And so it's all different, and it's a different world we live in. But, so we talked about before, humans, where people were resilient, and normalcy will come back at some point.
Well, one of the efforts in retail recently has been to make your visit to the store what they call an experience, right? And to the extent malls will be able to once again provide an experience, my guess is that, again, given our socialization culture, people will want to get back to them, but they're not going to want to walk through a mall with half the stores closed, I don't think.
Yeah. I guess they can do mini golf. There's things they can do, but yeah, we'll see. I mean, this is, I guess now things are strange because of the pandemic, but we'll see during, as things open up, hopefully, people will hopefully want to come out and be in public again and go shopping like they used to, but I don't know if they will. We'll have to see. So it's been a pleasure chatting with you guys. I think that we're out of time. If there's any last minute questions, but it was a pleasure. And you know what? I got one last question. I want to get this. I'm going to ask this one. The Main Street Loan Program. How effective has this been?
To date, it's been relatively ineffective. There's, I think, something like 1 or 1.5% of the funds that have been put aside by the government have been actually lent out. And the reason is that the underwriting process, it's as if the banks are doing a normal loan. So the what's called the participating lending institutions have to underwrite the loan as if their own criteria, because that the OCC puts out and how it gets rated. A lot of these loans, if the banks were to close on them, the banks themselves would then have to take an automatic hit based on the OCC underwriting standards. So I know there's some. I'm sorry.
Is there a solution to that, or what?
Better legislation. I know there's been, as part of the continued negotiations in the hallowed halls of Congress, that they're talking about the Fed especially is pushing for some relief, because if you're a company whose top line was affected because of the pandemic, right? Of course, you're not going to be able to meet underwriting criteria if your top line is down by 50%, although it's temporary. I mean, think of an amusement park, for example, or a chauffeur limo company, or something or movie theaters, to your point before about AMC, right? They'd be perfect for a loan like that, because it's to get you through, it's to get the company through the next step, and it's to get the company through the pandemic. But if banks can't underwrite it, it's so hopefully our legislators will fix that.
Well, if they do make the loans, I think the fear may be that all of a sudden they'll have a whole new portfolio of bad loans if it turns out that the lending decisions weren't good ones. And I think the banks are concerned about being criticized for that if that should come to pass.
Right, based on the current standards. That's exactly right, Judge.
It's sort of like saying, don't take this medicine, it could make you sick. Anyhow, I think that's all the time we have for today. So it's been a pleasure. And I look forward to catching up with you guys, hopefully in person when it's possible. I remember it was great fun at the M&A Advisor conference in Palm Beach. The 3 years I was able to go there in person. And so I hopefully next February we can be back there in Palm Beach again. So let's just cross our fingers for that. And either way, we can talk, on the phone or offline or whatever. So let's catch up soon. And thanks to everyone for dialing in for this panel.
Thanks, Alex.
Take care.
Bye.
Time shakes, found you at the water. At first you were my father, now I love you like a brother. Earthquakes, shake the dust behind you. This world at times will blind you, still I know I see you. Come a little closer than you see. Come on, things are not always what they seem to be. Come on, do you understand the things that you can see? Come on, do you understand the things that you can dream? Come a little closer than you see. Heart breaks, the heavy words upon your shoulders. Where we burn on just smolder. Somehow I know I found you there. Wanna see if you can change it, change it. Still I know I see you. 10,000 people stand alone now. And in the evening the sun sets. Tomorrow it will rise. Time flies by, they all sing along. Time flies by, they all sing along. Time flies by, they all sing along. Time flies by. Come a little closer than you see. Come on, come a little closer than you see. Come a little closer than you see. Come a little closer than you see. She may contain the urge to run away, but hold her down with soggy clothes and breeze blocks. Cetirizine, your fever, scream me again. Never kisses, or do you ever send a full stop? Do you know where the waffles go? They go along to take your honey. Way down how we build our breakfast down and say my love, love, love. La la la, muscle to muscle and toe to toe. The fear is grip me, but here I go. My heart sings as I jump up. Your angry time, that's my shining up. Do you know where the walkings go? They go on to take your name. Way down our sleep, build a breakfast now. Let's eat my love, love. She bruises calls, she splutters pistol shots. Hold her down with soggy clothes and breeze blows. She's morphine, queen of my vaccine, my love, love. La la la, muscle to muscle and toe to toe. The mirrors grip me, but here I go. My heart sings as I jump out. Your anger turned as my shouting out. She may contain the urge to run away, but hold her down with soggy clothes and breeze blocks. Germany, disinfect the scene, my love, love. Please don't go. I love you so, my lovely. Please don't go, please don't go. I love you so, I love you so. Please don't go, please don't go. I love you so, I love you so. Please break my heart. Please don't go, please don't go. I love you so, I love you so. Please don't go, please don't go. I love you so, I love you so. Please break my heart. Please don't go. I need you hold. I love you so. I love you so. I love you so. Please don't go. I need you hold. I love you so. I love you so. I love you so. I love you so. I need you hold. I love you so. I love you so. I love you so. Please don't go.